Hello and welcome to the Commonwealth Bank of Australia's results announcement for the financial year ended 30 June 2017. I'm Melanie Kirk and I'm Head of Investor Relations. Thank you to everyone who has joined us here in the room, via the phones and on the webcast. For this briefing, we will hear from our CEO, Ian Narev, and our CFO, Rob Jasusen. This will be followed by the opportunity for analysts and investors to ask questions. I'll now hand over to Ian. Thank you, Ian.
Thank you very much, Mel. Good morning, everybody, and thank you for joining us for this review of our financial results for the 2017 financial year. And I'd like to say it's a particular pleasure to have our new CFO, Rob, to talk about the results with me today. Just before we get into the numbers, I just wanted to say, obviously, the Commonwealth Bank's had a lot of attention over the last few days for not great reasons, for reasons that don't reflect well on the bank or on me. And we understand investor interest and analyst interest and public interest in that topic and are committed to being as open as we possibly can be about it. So I won't have anything specific to say in my run-through of the results, but obviously happy to answer any questions that you might have following the run-through of the results. And the headline numbers are pretty good for the 2017 financial year. So we've got statutory profit at $9.928 billion, up 7.6%. Cash net profit after tax at $9.881 billion, up 4.6%. Cash EPS up 3.5%. Dividend per share, we've announced a dividend, an interim second half dividend of $2.30, taking the year's dividend to $4.29. That's up 9 cents year on year, 2.1%. And a cash ROE of 16%. And one of the key themes, I think, underpinning the result is continuing to manage the Commonwealth Bank for the long term, but also recognising the exigencies of the environment in which we're operating. So the revenue growth of income growth of 3.8%, maybe against some historical benchmarks, doesn't look too spectacular, but for this environment, it's represented a pretty good mix of balanced growth and margin management. We've got expenses at 2.4%, and that's a balance struck between the need to keep working on the productivity of the business, but our commitment as a board and a management team to keep investing in the business for a future. So that's given us 4.8% operating performance. The strength of the balance sheet, you'll see a bit later, I'll describe that a bit over time, but on these key ratios, 67% deposit funding, liquidity coverage ratio of 129%, and then our capital of 10.1% on the APRA basis and 15.6% on the international basis. And then in terms of the ROE and the dividend, obviously closely linked, keeping the ROE at 16 and having a dividend of $4.29. The result, as we have increasingly emphasised over recent years, linking it to our vision of securing and enhancing the financial well-being of people, businesses and communities, really does benefit a wide range of stakeholders. Customers, shareholders, the nearly 52,000 people whom we employ, and of course at $3.9 billion in taxes in this period, we remain Australia's largest taxpayer. And starting where we ought to with our customers, and we can see here that what we have got is the continuation of an emphasis that we've had for a decade. And you can see here that going back to what was generally considered sort of the start of our focus on customer satisfaction, you can see that the measure of customer satisfaction among our retail MFI customers went up from 70.5% to 82.7% over the 10 years. And we've had the number one position for the end of this year and for the vast majority of the time since we first hit that number one position. That number one position is shared as first equal in business and across wealth and internet banking and international surveys as well. So that consistent customer focus coming through in the surveys. And very importantly, we've also seen over this period of time a significant reduction in the proportion of customers who are dissatisfied. And one of the main themes we've had to focus on over recent times is even as the levels of satisfaction go up, we must have a commitment to get levels of dissatisfaction down as well. And there's always going to be more to do on that, but you can see again that the efforts of doing that have had good outcomes over the 10 years. In terms of activity for those customers, I'm not expecting you to read all the fine detail on the chart, but the key point is that there is activity right across the country. And when you add it up, you can see that just in this financial year, we've done $197 billion in new lending, 330,000 new home loans. We've extended $6 billion in new loans to rural customers. We've insured more than 6 million customers. We've opened 2.7 new deposit accounts, and we've helped 1.8 million customers do their investment for the future. So a really wide impact right across the country, right across the range of customers' needs. We've had a focus for a number of years, as many of you will know, on this idea of one CommBank. And the principle of one CommBank has put ourselves in the position of our customers and put us in a position to meet as many of their financial needs as we can by making it easy to deal with the organisation in one place. And that's continued to be a focus for us in this financial year. And here are a few examples of the very specific activities linked to that One CommBank program. So we're developing better insights about our customers, obviously with all the bounds of the appropriate use of data and privacy, 62,000 customer insights each week. Our video conferencing, which is in the vast majority of our branches, providing 43,000 video conferencing referrals in FY17. 93 new branch lenders in FY17, and that's an important link to the chart on the right-hand side, and this has been a topic of discussion among analysts and investors for some period of time, and you can see here that the work that Matt Common and his team have done over time in having our people work better in our branches together with technology interfacing well with customers has made a really significant difference to the proportion of our new home loans that are coming in through proprietary channels. Now, we remain believers in the broker channel. We remain committed to the broker channel, and in fact, in one of our announcements today, we've made it clear that John Simon has executed his right to ask us to buy the remaining 20% of Aussie home loans that we don't already own, and we're very happy to do that. So we're believers in the broker channel, but you can see here a real focus on proprietary flows. 8% in growth in home and contents insurance, and again, I'll diverge a little bit here to another of our corporate actions. So we're talking here about home and contents insurance. We absolutely believe that being in a position to meet our customers' life insurance needs is absolutely core to the vision of securing and enhancing financial well-being. But quite a long time ago now, going back a couple of years, well before any of the media relating to CommInsure last year, before APRA's capital changes, Annabelle Spring kicked off a piece of work in the wealth management business, which we referred to as we were being asked about the thinking we're doing, say, what are the strategic options for this business over the future? And the underlying strategic thought, which Annabelle and her team had, and again working with the Group Executive Committee, was to make sure we can distribute life insurance but be open to the strategic options of manufacturing life insurance. And over this period, we've indicated in the corporate actions that that has now expanded as a piece of work with Annabelle, driving it together with Victoria Short, now our Group Head of Strategy, engaging with people who are interested in that business. The outcome of that is still uncertain, so there are a range of options, but that is an important development in terms of the strategic thinking that's been going on for some period of time. Continuing to believe in the branch. 226 new format locations, and we remain very committed to the idea that even in a world where later on the investor materials you can see increased use of the app, increased engagement with us through digital channels, the branch remains a critical need for customers and a critical part of our competitive advantage. And we now have 226 new format locations, but they must be formatted to have a different way of engaging customers and also make sure that we are having them contribute to the focus on productivity. You can see there a 50% reduction in branch space. The focus on innovation, in addition to making life easier for our customers, is really extended as a critical pillar of our focus on financial well-being. And a lot of work that's being done right across the business has focused on the question of what can we do with all our products, all our services and digital channels to really look after customers' well-being. And you can see here a couple of examples which were developed in the CommBank lab: our spend tracker functionality, a savings jar which helps people save small amounts gradually towards big amounts, and extending beyond the traditional banking business into CommSec, where we have made share trading more affordable with the launch of CommSec's $10 trade. The fundamental strategic principle behind the Commonwealth Bank for some period of time has been more satisfied customers, more engaged customers will deliver good outcomes for shareholders. And a critical aspect of this is who are our shareholders and who does this profit benefit. And you can see here that 80% of the value of the Commonwealth Bank is held by Australian families. 800,000 of them Australian families who own our shares directly, millions more through super funds or by personally investing in funds. And to get this to the important level of what does it actually mean for the individual shareholder, $3 in every $4 that we have earned this year, as it has just about every year, has gone back to those shareholders, 80% of whom are Australian families. So Australians' overall share in $3 out of every $4 of this profit. The other dollar is spent investing for the future, investing in the strength of the bank. And if you were one of the families who had the average shareholding of the Commonwealth Bank in June 2007, it was worth $47,000. Through the combination of share price increase and dividend reinvestment, you've had a return of 165% over that period of time. So this translates the overall profit number for the Commonwealth Bank into what does this mean for the Australian families who actually own us and who we do our best for. A key aspect of being able to continue to perform well for our shareholders is the focus on return on equity. Rob will have a little bit more to say about that, but you can see here 16% in the first half, 16.1% in the second half. And it's that underpins our ability to pay a good, consistent dividend. Outside the customers and our shareholders delivering here for the community, we remain Australia's largest taxpayer even before the banking levy, $3.9 billion in tax in FY17. That's equivalent to 260 schools, equivalent to 6 hospitals, so we're making a big difference as a taxpayer. And then beyond that, investment in the community, $272 million invested in the community just in this financial year, 575,000 students in Start Smart. And importantly, as we think about the community and we think about needing to be a diverse organisation to be able to serve our community effectively, being an employer of choice for gender equality, among many other areas of diversity that we're focused on at board and senior executive level at the Commonwealth Bank. Delivering over the long term for the community means being strong. And while we talk a lot period on period about the changes in the key metrics of the balance sheet, what you can see here is how different the Commonwealth Bank looks now relative to 10 years ago. Deposit funding having gone from 54 to 67, long-term funding from 49% to 60%, weighted average maturity of new issuances from 3.4 years to 5.2 years, liquid assets from $15 billion to $142 billion, and common equity tier 1 on the APRA basis from 4.5 to 10.1. So if you take that 10-year view, a very, very significantly different balance sheet in terms of strength than we had immediately before the global financial crisis. I'll now hand over to Rob to talk in detail about some of the key themes in the result.
Thank you, Ian. So a really pleasing result this year. Strong home lending, business banking and transaction account growth as we continue to leverage our market-leading MFI franchise. Positive jaws again as we take a strategic approach to investing through the cycle. However, we are adjusting to the lower revenue environment and we're really making sure that our business settings are flexible. As part of that, we continue to strengthen our balance sheet, both in terms of wholesale funding and also our capital ratio. So turning to the FY17 result, operating income up 5.4%. You recall in the first 6 months of the year we sold some Visa shares. On an underlying basis, up 3.8%. Operating expense up 6.2%. In the first half, we had the accelerated amortisation of $393 million. On an underlying basis, up 2.4%. So positive jaws of 1.4%. Operating performance up 4.9%. We continue to experience very benign LIE conditions. So at the group level, it's 15 basis points for this year. So loan impairment down 12.8%. So cash NPAT at 9,881, up 4.6%. And as we indicated at the first half, the tax rate is consistent at 28.4%. Breaking down operating income, net interest income up 3.9%, other banking income up 5.4%, funds and insurance flat. A big driver of our net interest income performance was very strong volume growth, up 5.6%. That was driven by home lending and business lending, both up 6 and 5% respectively. Good asset pricing performance. That's really driven by investor loan repricing as we moved to meet APRA's prudential rules that were brought in. Funding costs were 4 basis points drag. That's driven by wholesale funding as we lengthened our tenure, and that led to an increase in net stable funding ratio. The impact of New Zealand on the group margin was 2 basis points. Capital was a 2 basis points drag. During the period, we held more capital, but the cash rate was lower, and so the return on that capital was lower. So net interest income up 3.9%. Turning to margin, flat in the second half of the year. Asset pricing down 1 basis point. Now, that's driven by very strong competition in business lending, both in the BPB business and the institutional banking business. In institutional banking, really driven by Asian banks participating in the market. Very good volume margin trade-off on the deposit book, up 3 basis points. And there was a drag of 2 basis points from Treasury and Markets, really driven by liquids. Now, that's the higher liquids we held as we increased our liquidity coverage ratio by 9% to 129%. So margin in the second half flat at 211 basis points. Other banking income up 5.4%, very strong growth in commissions, higher credit card purchases and lower loyalty costs. Lending fees up 6.7%, that really tracks the volume growth I mentioned in the earlier slide. Trading income up 5.7%, driven by our DVA. Actually, sales were down, and that's really driven by second half performance due to lower volatility in markets. In other, you'll see a reduction of 134 million. The main driver of that was a higher realised loss on our New Zealand earnings hedge. Funds and insurance income flat, strong growth in funds under administration and assets under management, offset by a decline in foreign exchange, offshore exchange rates versus the Australian dollar. Margins down as well. That was the shift by customers out of emerging market equities into cash and bonds. Insurance income down 1.1%. Average in-force premiums up 1%, offset by an increase in income protection claims. We continue to manage costs through the cycle. We believe our investment leads to better customer experience and ultimately stronger revenue growth through the cycle. Year on year, underlying up 2.4%. In the second half, very strong cost performance in terms of staff costs and technology costs, up only 0.4%. We took the opportunity to increase investment, up just under 35%. That was both in terms of regulatory spend and digital spend. Because of the nature of those type of investments, it was all expensed. Turning to divisional contributions, I'll talk about RBS, our corporate business and wealth, in the coming slides. Another great year for the ASB team, operating income up just under 5%. That's driven by strong home lending performance in Auckland. Very good expense management. You'll see a big reduction in LIE. That's the unwind of dairy provisions as milk prices recovered. In Bank West, relatively low operating income growth of just under 1%. As you know, the macroeconomy in Western Australia has been relatively subdued. Operating expense up 2.7%. That includes a one-off provision of $27 million as we integrate the Bank West business banking business into BPB. Earlier I mentioned that we really keep our business settings flexible as the environment changes. I think the IFS team have done a very good job in terms of that. Operating income down 1%, really driven by a subdued macroeconomic environment in Asia, also the impact of a strong Australian dollar. But operating expenses down just under 13%. But that team continues to invest in digital, particularly in South Africa, but they're managing operating leverage very strongly. So cash NPAT in that business up just under 80%. Another great year for Matt Comyn and team. Very good margin volume management. So good growth in home lending and household deposits. Margins up 1 basis point in the second half of the year. Very strong jaws growth, 4.5%. And a world-leading cost-to-income ratio, now at 30.8%. In terms of our corporate businesses, really two stories here. Very strong growth in business banking, up 5.8%. In terms of institutional banking, Kelly and team have really focused on portfolio management. Margins up 1 basis point in the second half. Very strong deposit margin performance, offset by that strong competition I mentioned earlier. For a couple of years, we've highlighted that we're investing through the cycle in BPB, particularly in frontline sales capability and also technology. Albert's a good example of that investment. So negative jaws, low LIE, and NPAT up 7.7%. The portfolio management in institutional banking has led to lower revenue growth, but very good expense management by that team. LIE down 75% and NPAT up 9.7%. Turning to wealth, good growth in assets under management and funds under administration. Insurance income is down 12.7%. That's the impact of higher loss recognition. Insurance claims up 9.5%. That's really in the second half of the year, and that's the impact of Cyclone Debbie. Loss recognition is taken as a contra revenue item, so revenue down 2.5%. Good expense management. Expenses down 1.7%, NPAT down 9.6%. For a number of years, we've said in terms of impairment that we're sort of at the bottom of the cycle. Very low impairment in this period as well. At the group level, 15 basis points, slight elevation in terms of consumer, but corporate LIE is now 8 basis points. Turning to arrears, slight elevation both in personal loans and credit cards. Home lending continues to be very low. The slight increase is driven by Western Australia. Deterioration both in mining towns and also greater outer metropolitan Perth. If you strip out the impact of Western Australia, you can see at the rest of the portfolio level, no deterioration over the last 3 years. Total provisions flat at $3.7 billion. Elevation in consumer, both individual provisions and collective provisions. Reduction in collective provisions in the corporate book. Economic overlay unchanged for the period. A real highlight of the result is our Common Equity Tier 1 ratio of 10.1%, but you can see from this slide across a number of our balance sheet settings, we continue to be very conservative and lengthen our wholesale funding. ROE 16% for the period. As Ian said, our deposit funding now is 67% of total funding, up 4% over the last 2 years, driven by very strong transaction account growth. Our net stable funding ratio is at 107%. Wholesale funding, we've lengthened the term, so it's up to 5.2 years on new issuance, and also the proportion of long-term wholesale funding is now 60%. As I mentioned earlier, our liquidity coverage ratio is up 9% at 129%. The portfolio management that I mentioned is undergoing in IB&M has led to a reduction of $7.5 billion in corporate credit risk weights. That's had a positive contribution to capital of 25 basis points. Optimizing the balance sheet will remain a very important part of our strategy. Common Equity Tier 1 at 10.1%. We remain very well positioned to hit the APRA benchmark of 10.5% by January 2020. Another feature of this result is the very strong organic capital generation at 72 basis points. In the year, we had a drag of 23 basis points of colonial debt. That's $1 billion rolling off in the second half of the year. FY18 is the last year of impact that we'll have of colonial debt, and that will be 15 basis points. We also received from APRA their guidance on mortgage risk weights, 25.25%, and that had an impact of 34 basis points. The board approved a dividend of 429 cents, up 2.1%. That's a dividend payout ratio of 75%. So we continue to manage for a very strong balance sheet and capital ratios. As I said, we feel very comfortable about reaching the APRA benchmark. Today we're announcing a DRP with a discount of 1.5%. That will have an impact of 20 basis points to capital. Very strong organic capital generation in the period, 72 basis points, as I mentioned. If you look at over the last 5 years, the average is 52 basis points. We'll continue to optimize our balance sheet. Of course, as I mentioned, we had the last year in FY18 of the colonial debt. So in summary, very strong performance, really pleasing result. We continue to leverage our very strong customer franchise. However, we're adjusting to the environment. We think it's important to continue to invest through the cycle, both in terms of meeting our regulatory obligations, but also technology. It's consistently led to higher revenue growth. And we also continue to strengthen the balance sheet. So with that, I'll hand back to Ian for the outlook.
Thanks very much, Rob. If we look through the lens of these results and the key data provided by Michael Blythe and Stephen Halmarick and their teams, what we can see is an economy which, to quote the Reserve Bank Governor, is okay. Actually, if you look at the key economic metrics in the Australian economy, most of them are as good or in many cases better than they were 6 months ago and certainly 12 months ago when we were talking about the result. But the experience of people within the economy geographically in different parts of the economy is still varied. And we do see ongoing concerns at the household level about job security, about wage growth and about the cost of living. So from the point of view of the broader macro environment, the key is for policy and business investment to come together to create an environment where a broad base of businesses continue to invest to create jobs and create that third wave of investment support for the economy beyond the more cyclical investment phases in mining, capex and then in construction. From our perspective at the Commonwealth Bank, ongoing focus on strength, ongoing focus on customer engagement, as I said, both at the face-to-face level and through digital channels and technology. And if we had to talk about a slight different of emphasis from the trajectory we're on at the moment, an ongoing and accelerated focus on productivity, making sure that we can continue to get operating efficiencies in the cost base, but at the same time can continue to invest. And as we have said for some period of time and continue to believe more than ever, the quality of our people, the values that they show, the commitment that they have to the Commonwealth Bank remains the key to our success. I'll now hand over to Mel to moderate the Q&A.
Great. Thank you, Ian. For this briefing, we'll be taking questions from analysts and investors. We'll start in the room and then move to the phones. Can you please wait for the microphone, state your name, the organisation that you represent, and to allow everyone the opportunity, please limit to 2 questions. We'll now start with John.
Thanks, Mel. John Mott from UBS. One of the highlights of the result, and something that we've been seeing for a while, has been that you've been becoming more and more reliant on brokers, but over the last 12 months, you've really turned that around, and congratulations to everyone on really improving the proprietary sales. That it's one of the highlights of the results. Now, given the proprietary sales have improved so much, and that we've recently seen both the ASIC and Sedgwick reviews, are you now in a position that you should be reviewing the amount of commission that you are paying to mortgage brokers, as this is the one part of the value chain across the whole financial services market that has seen no pressure over the last decade?
Yeah, it's a good question, John. I mean, in terms of the Sedgwick review as with all the ABA initiatives, we've been deeply involved. I think Stephen Sedgwick did a very high quality piece of work, and in terms of the impact of his recommendations on our own networks within CBA and Bank West, we're really implementing those on an accelerated basis. What we have said and are doing in terms of broker commissions is that there's obviously other parties involved here, and we are working with the broker community and engaging very deeply with the broker community, and I know the ABA is doing work on it as well to find out what is the best way for the spirit behind the Sedgwick recommendations to be reflected in broker commissions. So it's too early to tell where that will come out, but obviously given the focus of the industry, it's a topic where there'll be more to hear and probably relatively soon.
Great, we'll move to Richard Wiles.
Good morning, Richard Wiles, Morgan Stanley. Rob, I'd like to ask a few things about the mortgage book. Can you tell us what the debt-to-income ratio of new loans was in the June quarter following the APRA announcements, the APRA restrictions, and how that compares with a year ago? And can you tell us what proportion of interest-only home loans have switched to P&I in the last quarter since those APRA restrictions?
I'll make a couple of comments, then I might hand over to Matt. But we don't publish the debt-to-income ratio, but how we think about it is based on serviceability. You'll see in the presentation we have floors in a low interest rate environment, and so that's our approach.
Yeah, Richard, as Rob said, we don't disclose, but it's largely unchanged actually for a number of years, the loan-to-income or debt-to-income ratio. I think there's sort of two parts to your question that are important. One is the flow restriction on interest only. So you'll see the figure that's disclosed here, that's the average for the half. It reduced quite substantially in the last quarter as we took both pricing as well as other tightening. We're currently below the 30% this month, and we will be comfortably below the 30% at the end of September as APRA have requested. In terms of how many customers are switching, I can't give you the specific numbers. As you would appreciate, we see that to be more pronounced with customers who are owner-occupied, and I see it's also very early days because the pricing changes only came into effect in the last month or two.
Do you have any idea, do you have any expectations for the amount of switching?
I do, but not necessarily to disclose today.
Great, we'll move back to Jared.
Jared Martin from Credit Suisse. Rob, you've given a glowing review of the capital position with a core equity tier 1 of 10.1%, 70-odd basis points organic capital generation. You've got further balance sheet optimisation, which you said was 25 basis points this year, a lower impact of the colonial debt next year. And even if you just use your 5-year average of organic capital generation of 50-odd basis points, you're going to get pretty close to the 10.5%. Yet you've introduced a dilutive DRP discount. I'm interested in your rationale behind that, considering what I've just heard here is a very glowing review. Why do you need to do a DRP discount when other banks are in fact actually neutralising DRPs? Do you feel that you actually have to get to 11% and get to 11% sooner rather than later?
No, I mean what we're targeting is the APRA benchmark. We're taking an approach in this environment, in a lower revenue environment, to be prudent and move there quickly. It's 20 basis points.
I mean, in terms of the board's overall view on this, Jared, I think the path under most scenarios which Rob and his team and Paolo and Tricia are providing, we get to the benchmark very comfortably. There are always assumptions based on organic capital generation, which has to do with economies and credit quality and all those sorts of things. And we're in a position where I guess we just say for something with relatively minimal dilutive effect, which is relatively easy to do, we'll err on the side of being a bit more cautious on capital. Beyond that, there's not really any either implicit or explicit signal.
Can I just jump on something that Rob said then, that it's not a buffer above the 10.5. 10.5 is now the target. We shouldn't be looking at buffers upon buffers and therefore higher than that. But 10.5 now is the target from a CBA and a board perspective.
Yeah, APRA's guidance is 10.5 at the reported date, and obviously like any ratio, at certain periods will be slightly higher. Certain periods post-dividend, we might be slightly lower.
Great. Thank you. We'll move to Victor.
Thank you, Mel. Victor Guerin from Macquarie. Both Ian and Rob, you've mentioned a few times during your presentation the need for further investment in the business. Just interested in sort of maybe if you can give us a little bit more colour as to where you think this investment needs to take place. And in light of some repricing opportunity that the industry have taken in 2016, there is some uplift in revenue that presumably should come through. Just interested in how you are positioning on the investment spend, and given your historical view around jaws, would you use that as an opportunity to further invest in some of the areas where you think that investment is needed? And second question, just on follow up on capital. One of the things that's sort of interesting is that your risk weights on mortgages are after APRA's clarification at 25%. They're still quite a bit lower than two of your major bank peers. Just interested in your observation as to why you would have a lower risk weights on mortgages than two of your peers at least.
Well, let me take the first question, and then Rob can talk about the risk weights, or either David or Matt or Fiona can talk about it. If you look at pages 75 and 76 in investment spend, Victor, I mean, a couple of things are going on. Number one, from a strategic perspective, we really have a view that the continued adaptation of the business, both from the point of view of the front end and the productivity of the operating base, is a lot more work to do, and there will be for a long period of time. So we don't see the pace of that kind of investment abating. Clearly here you've also got a big number each year on risk and compliance, and you can see on page 76 we've said that over the 5 years that's north of $3.5 billion, and we don't see that the overall regulatory requirements abating anytime soon. So I think for the time being our expectation would be similar levels to investment. They always go up a bit or down a bit each year depending on what we choose to invest in, but overall similar levels. And that's part of why we want to up the focus on productivity to make sure we're creating for ourselves the capacity to do it. At whatever point in time the demands of regulatory and compliance spend are lower, then there'll be a decision to be made as to whether or not that, from both a financial capacity and a people capacity, can allow us to invest more elsewhere. But that might be a period of time where we look at things and say it may be possible to invest a bit less.
So in the context of if revenue permits, just in the context of potentially better revenue outlook next year, if that does come through, do you see potentially cost growth exceeding this year's cost performance?
I think we've always said that we're going to invest for the future, and clearly when revenue picks up a bit, we've got appetite to spend a bit more. The question is, what's the kind of spending? So it doesn't mean that automatically if revenue is better than expected, we'll just invest a whole lot, because one of the key constraints of investment is making sure we've got the best people focused on the outcomes, and often the constraint is the quality of the project team and the investment versus the dollars. I would imagine if we have better than expected revenue environment, you'd probably see expenses through investment maybe going up a little bit more than they would otherwise, but I don't think that would be a dramatic determinant. Do you want to talk about capital?
Yeah. So in terms of your comment on mortgage risk weights, I'm not going to comment on our peers. What I will say is this was the guidance we received from APRA. The quality of the book's very strong. Obviously in the last 12 months it's grown, and that's had an impact on capital. But you saw from the arrears performance, the LIE performance, very strong, high-quality book, and that's reflected in the guidance APRA's given us.
You don't expect further changes?
No, Victor, wait. We'll take the next question from Craig Williams.
Thank you. It's Craig Williams from Citi. Look, it's plain for all to see that the operating performance of the bank in this result's very solid, particularly relative to peers. What also seems apparent is that the banking industry needs to work harder to ensure a culture where staff feel free to escalate bad news, that matters raised by staff, customers and regulators are promptly dealt with if it's to remain the master of its own destiny in terms of avoiding ongoing problems with authorities and in order to maintain its social licence. So can you use this forum to highlight what action the board and executive team at CBA is taking in order to address this sort of threat from within?
Yeah, I couldn't agree with you more. It's a very important aspect of big companies. It's a particularly important aspect of big financial companies. And it's a very important aspect here at the Commonwealth Bank. And in many ways, what we need to be working on is overcoming what can sometimes be an inherent fear of speaking up. That's something we need to acknowledge. Now, if you go back, I think, to 6 years of weekly notes that I've written to staff, and you map those to the sorts of notes that the team here has written to staff, I'd say speaking up has been one of the top themes. We've backed it up with action, including but not limited to the responses to the ABA initiatives around speak up hotlines, around new whistleblower policies, etc., all of which are absolutely critical. We've all got more work to do on this, and it's difficult in a big organisation, and we just can't tire of trying hard to do it. One of the things that the board tests, and I certainly test it with my team and they test with their teams, is have we got leaders who don't just say that, but in the way they deal with this, particularly where the criticism is made of them or their teams, are we going to take action? And what we see critically in our People and Culture survey this year, the single biggest increase, and we know this survey is reliable because last year it wasn't that great, other than I'm proud to work for the Commonwealth Bank, was I feel it's safe to speak up. And that is a very, very significant development from our perspective. But boy, we're never going to stop worrying about that.
We'll take the next question from Brian Johnson.
Brian Johnson, CLSA. I had two questions. The first one is, and sensibly, we're hearing that you've got to really think banks are distribution businesses, so looking at manufacturing. In that regard, could we get a feeling for how much regulatory capital is tied up in the life insurance business, the tangible equity and the total equity, including the intangibles? And then just along the same vein, there's been consistent media reports about basically the divestment of Colonial First State Global Asset Management. Along the same vein, could we actually get some kind of commentary on whether those reports are actually correct? And the second one, Ian, and thank you very much for fronting us and actually allowing us to ask questions on this. But when we have a look at the AUSTRAC investigation, you've very kindly made yourself available to the journalists to talk about the mechanical coding error. I'd just like to find out two sentences to read out from the AUSTRAC Conso Statement of Claim, and what I'd like to find out whether this is correct or incorrect. Paragraph 10. A further 6 of the late TTRs related to 5 customers who had been assessed by CommBank as posing a potential risk of terrorism or terrorism financing. Is that correct, yes or no?
Brian, you'll appreciate I'm really committed to being as open as we can on this topic, and the normal modus operandi on these things is to say it's subject to legal proceedings, which we haven't done. On specific claims, you'll just have to understand I'm not going to be able to give yes or no answers to that.
Okay, paragraph 12. It basically talks about structured transactions and the non-reporting of them. So this is where a transaction, I believe, is just below the $10,000 limit. But the second sentence says, in part, this was because CommBank adopted a policy not to submit SMRs if the same type of suspicious behaviour had been reported any time within 3 months prior. Can we just get confirmation that, in fact, there was, that the words in there are correct, that there was a policy of non-reporting if it had been reported once? Yeah,
I'll give you the same answer, but with a bit of important colour here, and then I'll come back to the questions you've asked about the transactions. What's very important to understand, I think, about the nature of the claims made by AUSTRAC that we're working through, and also everything we know to date, there's no deliberate intention to do the wrong thing anywhere in these claims. It's a really important distinction. Now, we've got to play our part in working with AUSTRAC, and we have a very constructive relationship with them and with the AFP and others, and doing everything we can to perform our role in helping them doing what they're doing. And I've already said we've made mistakes here, and as we review the claims, we'll become clear on those. But there's no bad intent, there's no ulterior motive, there's no profit motive. What we will make sure that we do is look at each of the policies, including the ones that are alleged there, and if we haven't already changed them, and you'll see in the board statement this morning, a very significant amount of work's been done since 2015. Is everything perfect? Absolutely not. I'm sure. I doubt. I'm certainly not going to say that. And these are big areas. And even if they were, we've got to get better and better. But we'll keep looking at policies and processes and see within the very, very significant amount of work we're already doing. If there's still more that need to be done, it'll get done, and no stone will be left unturned to look at that. In terms of the transactions, no, we're not going to be able to give guidance on that at the moment. You'll appreciate we've said that we're in discussions, the outcome's uncertain, and all this stuff is very commercially sensitive. I think you'd be able to make a decent inference that if we end up not the owners of this business, there will be a capital benefit. And in terms of other aspects of the business, we've got nothing else that we can say.
You can't tell us the equity.
Great. We'll take the next question from Andrew Lyons.
Thanks. Andrew Lyons from Goldman Sachs. Just a question around the margin and particularly the competition that you saw in business lending in the second half. Just thinking about the trajectory into 2018, just with reference to slide 18, some of the variables that you sort of put forth there. You know, asset pricing, obviously, you've got the full half benefit of some of the IO repricing that was done through the half, and then further repricing that was done at the very end of the half. Funding conditions still look pretty solid. You'll still have a bit of a headwind from the replicating portfolio, but against that, obviously, you're at the very top end of your LCR guidance range, so that headwind is unlikely to continue. So I'm just interested just to get a bit of a feel about, particularly around business lending, which is potentially one of the headwinds that you could be faced into FY18, just exactly what's driving that, and has it continued to accelerate through the half?
Well, you'll appreciate, Andrew, we don't give guidance on margins. But what I will say is a number of the trends that you've highlighted are correct. The repricing in home lending was in the late period of sort of end of May, so you'll see that flow through. Business lending's a very dynamic competitive environment. I think what you've seen over a number of periods, though, is the team, both on the asset side of the balance sheet and liability side, are very focused on volume margin trade-off. And we make those calls as we see the competitive environment evolve.
We're going to move to the phones now, and our first caller is Matthew Wilson.
Yeah, good morning. Two questions, if I may. Firstly, to slide 79, you disclose that you have $1.8 million mortgage accounts. Do you also have 1.8 million units of corresponding collateral, or is that mortgage account number impacted by loan splitting? And then secondly, why does it take action initiated by APRA, not CBA, to moderate growth and change underwriting behaviour in certain mortgage segments?
Well, let me answer the second question, and then I'll let David talk. And obviously, Matt, you and I have spoken a large number of times over the years about this topic, and I know you're a very informed observer. The reality is that we look at risk appetite in home lending from a board-governed risk appetite statement, which focuses on a number of different issues, but as Rob said before, its absolute core is in serviceability and in assessing the ability of borrowers to withstand changes, particularly in the interest rate environment. We set buffers for that and are very comfortable with that. The reality is, if you look at the interests of macro-prudential regulators, and the flow-through of this regulation is RBA through APRA, is that the major concern that the Governor has talked about is not near-term credit quality, but it is the aggregate of reduced consumption into medium to long-term economic prospects if interest rates go up, which is a very legitimate concern, and if that happens, the aggregate level of household indebtedness in the economy. And that's a very appropriate approach for macro-prudential regulation, because in assessing credit quality of borrowers, it's actually their behaviour in aggregate that is going to do that, rather than the situation of any individual counterparty. But there's very good dialogue between the APRA and the Reserve Bank and the banks, and I think we're all trying to move in the same direction. We've all got a common interest in having a very stable basis for the Australian economy. And David Cohen, was going to answer the second question.
So just in relation to the accounts question there, So, yes, each of those accounts is collateralised, but you'll understand that there are sometimes individual pieces of collateral that cover multiple accounts. So, yes, all 1.8 million are collateralised, but it's not necessarily 1.8 million individual collaterals.
We'll take the next question from the phone, and we have Frank from Merrill Lynch.
Good morning, guys. Two questions from me. The first is, can you please talk through how much scope remains for balance sheet optimisation over time? And secondly, a couple of expense items are a bit noticeably higher than usual. So namely, there was a 23% kick up in superannuation expenses, and that represented the entire increase in your staff expense, and also a pretty big increase in professional fees. So can you talk about what drove that and whether the drivers are transient or permanent over time?
Do you want to talk about the first thing, and I'll talk about superannuation, about balance sheet optimisation?
Sure. Could you repeat the first question? I couldn't fully hear it, Frank.
Sure. The first question, can you please talk through the scope for remaining balance sheet optimisation over time?
Yeah. I'm not going to give guidance on the extent of it. What I would say is both in the institutional bank in particular, but other businesses will be looking at portfolio optimisation. So looking at returns, basically, and what is the best risk-return trade-off.
And in terms of the super, I mean, in this period, we've done a lot of work on the policies and looked at the way the policies are applied across our business, and as a result of that have made some retrospective payments which are in these accounts and are going to be a one-off.
We'll take the next question on the phones from Azib at Morgans.
Thanks, Mel. You provided an estimate to the market in May with regards to the impact of the levy. That estimate is looking quite light compared to the estimates that your peers have provided. So are you still happy with that estimate? And do you have any clarity in terms of the impact on the P&L? Can we expect that to come through the net interest income line, or will it be some other line? And then just a second question on your institutional loan growth. So your institutional loan book was shrinking over the first half. It's now expanded by 2% over the second half. As part of Rob's commentary to the NIM waterfall chart, Rob, you did mention that the competitive dynamics there still remain quite intense and there is margin pressure there. So can we conclude that any runoff of low-returning exposures in that business has now come to an end? And what are you seeing as the opportunities for growth in that space? Where is that 2% growth in the second half coming from?
Well, I'll get Kelly to talk about the second question first, then I'll come back to the banking levy.
So on loan growth in institutional banking, it really is based on what we see in the market at the time. And you'll appreciate that they're large deals, so it's never a steady flow from one period to another. All our decisions are based on what we can do at the time. And on portfolio optimisation, we might be constantly testing the market and where the pricing is at for the risk that we want to offload, as well as it depends on which deals we win in the market, such as the privatisations. There were 5 this year. They weren't evenly spaced throughout the financial year, and we were the only domestic bank on all 5. So all of those things will have an impact on the growth numbers from period to period.
In terms of your question on the levy, you'll see on page 65 that we have made an estimate here of $258 million post-tax. To your question, yes, because this is a specific levy applying to a particular class of product, it's actually going to be an offset to revenue because it's taken account of through the way we effectively look at our funding costs attached to those particular products. People always ask for what might the implications be to the bottom line, and the answer is because it's effectively an extra funding cost in the way that this is thought about in the business, then that is going to be set by the competitive market. So all we know is that we have a certain cost and a competitive market on the offset, which is on the revenue side, and we'll just have to see how that goes.
Great, thank you. At this point, we don't... So, Brian, one last question. Oh, sure.
I've got hundreds of questions, but I'm just doing them 2 at a time. On the cost line, in the previous half, we had the quite substantial accelerated amortisation of the software. And in this period, we had, I'm guessing, about a $65 million amortisation saving. Half on half, that implies that the costs, if you strip those two items out, like you're stripping out one but you're not stripping out the amortisation saving, that would suggest half on half the operating costs were up 3.5% half on half, which means, in fact, we had negative jaws during the period. I'm just wondering, if we're to strip out all the accounting malarkey, this is actually quite a woeful outcome on the operating costs, and I was wondering if we could get a feeling about what you're going to do to rein that in. And then the second one is that basically when we have a look at the income tax reconciliation, and I'm sorry if I sound bored, but I ask this question every year, I can see once again that we've got tax recoveries from prior years coming in as quite a substantial generator of value. Could you give us a feeling about the unrecognised deferred tax asset that we should expect to leak in conveniently into the P&L going forward? Because it's great to talk about the operating result, but before investors can assess what the value of the P multiple they should ascribe, we should at least know what the earnings quality is.
So, Brian, I'll take the question on costs. I might hand over to Gavin, who's our head of tax, to take the tax question. Look, on costs, what I'd say is we've got a real focus on investing through the cycle. If you look at this result, you've got 2 businesses with jaws over 4%. You've got 3 businesses where costs are down year on year. But there is a big focus on investing in technology and in regulation. As Ian said, though, going forward, productivity is going to be very important. As we think about the long term, ultimately costs will have to come down, and that's the focus of the team.
So Gavin Marjoram, the head of tax. What's going on at the tax line is effectively 3 things. Firstly, in terms of the rate rise from 27.5 to 28.4 from last year to this year, that's a change in business mix. And to give you an example of the sort of thing that's going on in relation to that, that's runoff of various structured financing transactions. So, for example, these are transactions where the tax cost has been set higher than the accounting cost, and as that runs off, the beneficial tax outcomes arise in relation to that. The second thing that's going on is our effective longer rate of 28.4%, and we're forecasting to be flat as we go forward as well. That's largely due to our business mix, and in particular the mix of onshore versus offshore profits. Offshore profits are generally taxed at a lower rate than our Australian profits. And the third key element that's going on in the tax line is an overarching principle of, I would call, conservatism and prudence. We see our responsibilities as Australia's largest corporate taxpayer as very serious. We take them very seriously. Part of that is making sure that as we recognise relevant tax assets and we recognise our potential tax liabilities, that we are very careful and prudent in the way that we do that and the way that we interact with tax authorities. So I would say our ongoing, and we've called out that our ongoing effective tax rate will be flat as we go forward from here.
So is this still quite a substantial unrecognised deferred tax asset?
So
that makes me feel good for 1 year, but when you're paying P13...
Well, so the unrecognised tax asset is disclosed in the accounts.
Right. Thank you. We'll take the next question from Brett.
Thanks. Brett Lemaitre from Velocity Trade. 2 quick questions for you. Can you tell us what proportion of the $70 billion of transaction deposits come through the IDMs? And then secondly, on the life insurance business, the ongoing capitalised losses, can you tell us, is that due to higher incidence of claims or longer average claims, or is there something else that's driving that?
Well, I'll get Annabelle to answer the second question first. And then Matt can take the first one.
On the life insurance claims and the loss recognition, sorry, I can't see you. Hi. On the life insurance claims and the loss recognition, this is an ageing book, so more than 80% of this book is more than 5 years old. So as you would expect, we're seeing longer, slower terminations. So not necessarily a higher incidence as the primary driver, it's long-dated terminations.
And Brett, if I understood your question, so the vast majority of transaction accounts are opened in branch. They're not originated via any of the deposit machines. And to access any of our deposit machines as a Commonwealth Bank customer, it's free. So not sure if that gets to the... Sorry, I can't actually see. Sorry.
What I really meant was what proportion of the transaction deposits outstanding, which is about $70 billion, come through the IDMs?
You know, it's really hard to break it down on that basis because obviously customers use their deposit and transaction accounts in a variety of different channels. Obviously, the mix of deposits has increased through the IDMs versus over the counter, but obviously electronic payments have grown exponentially over the same period as well.
Great. We'll take the next question from David Ellis.
David Ellis from Morningstar. I've got a question on slide 83, the serviceability slide. There's the chart on the left-hand side. Shows the gross average household debt to average household disposable income. And it's obviously it's widely reported that the ratio around about 190% is high, is very high and also high globally. There's hardly any focus on the net debt, and as pointed out in the slide, it's been relatively stable over the last 10 years or so. And not shown on the slide, of course, is average household wealth, net wealth to average household disposable debt, which is very high and increasing at a rapid rate. Do you think there's too much focus on the gross household, let's call it leverage ratio, rather than on the net rate and on serviceability and interest payments as a percentage of household income, which are also low due to obviously a low interest rate environment?
The first thing I think when you look at this chart is that it should cause questions, because this is an outlying chart relative to global experience. So the first thing we've got to ask ourselves is what's underlying it and are we comfortable with it? And you're making one very important point, which is if you're looking at the overall balance sheet of the household, it's actually overall strengthened pretty well. And that's a very important factor to consider when you're looking at the net debt, bearing in mind that underneath the effective wealth of the household is a whole lot of mark to market of what's my property worth and what are my assets worth, whereas the debt is debt. So you've just got to be very careful about the role of asset values in that, but overall that paints a better picture. What I think we all just need to also be thoughtful about as we look at a lot of average graphs, and equally importantly is what the distribution looks like. And actually, you know, the vast majority of Australian families are going to be in a position where their overall level of debt, etc., is resilient to all sorts of conditions. We've just got to make sure we don't take comfort just of the averages. So a lot of work which Matt and David Cohen and their teams are doing, is focused on the distribution and making sure that we really understand the risks in the tail.
Great. Thank you, everyone. That brings this briefing to an end. Thank you for joining us today.